This week on Wealth Track, ClearBridge Aggressive Growth Fund manager Richard Freeman has been on the fast track for 30 years with no signs of slowing down. Where is this great investor driving the portfolio now? That's next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Where do you come out in the classic Wall Street growth versus value debate? When you look at your portfolio, are there more value or growth stocks and funds? What's the difference between the two categories? Well, traditionally, growth stocks are defined as having higher than average earnings and sales, as well as price earnings multiples, and typically they pay little or no dividend. Value stocks are supposed to have slower growth and lower PE multiples, but pay higher dividends. Growth stocks typically perform better in bull markets. As you can see from this chart, they certainly have since the market bottom in March of 2009. A benchmark Russell Growth Index has vastly outperformed the value index. And value stocks are supposed to protect you more in bear markets. As a general rule, they have. But in the great equalizer market of the 2008-2009 financial crisis, both classes were hit hard. Well, Warren Buffett would tell you growth and value are meaningless distinctions. And here's how he put it in his 1992 Berkshire Hathaway chairman's letter. In our opinion, the two approaches are joined at the hip. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous, and whose impact can be negative as well as positive. This week's Wealth Track guest could not agree more. He is Richard Freeman, a founding co-portfolio manager of the ClearBridge Aggressive Growth Fund, which he now co-manages with Evan Bauman. The fund is celebrating its 30th anniversary this year and has outperformed the market and its peers in the large growth category over the last decade. Freeman has also been nominated twice for Morningstar's Stock Fund Manager of the Year award. I began our conversation by asking Freeman why, in retrospect, he thinks the fund should never have been labeled aggressive growth.
We started it as the Shearson Aggressive Growth Fund back in 1983, and it's not managed in an aggressive manner.
Okay.
I think it scared off a lot of people when they heard the word aggressive. It had negative connotations, rapid turnover, buying very risky stocks. If we could turn back the clock, which you can't do, it probably should have been the Shearson Growth Fund. We've been asked very often, why don't you change the name of the fund? I think after 30 years, it has an identity. People realize the ClearBridge Aggressive Growth Fund is what it is. It should have been called the Passive Aggressive Growth Fund.
Okay, passive aggressive, I love it. Why passive? What's passive about it?
The management style, if you look at the companies, they clearly could be called aggressive companies. They're state-of-the-art, they're sort of life-saving companies, companies that have products that can serve unmet needs, managed aggressively, but the way we manage the portfolio, we don't have a lot of turnover.
Right, 8% turnover, whereas your growth competitors, the annual turnover is 96%. That's incredible.
That's the passive part of it.
Right.
I mean, we're not reticent to change the portfolio, but give us something that we like more than what we have in the portfolio. And this has really been constant over the 30 years of the fund.
So what is your mission at the ClearBridge Aggressive Growth Fund? You know, if I'm looking at you and I'm saying, you know, should I invest with Richie Freeman and Evan Bauman? You know, what is it that I'm going to get from you?
The only mission that we have is to try to deliver good absolute returns over time. There's a big preoccupation on the street with relative returns, benchmark investing. We're benchmark agnostic. We can care less what's in the benchmark.
So you don't care what's in the Russell 3000.
No,
you're not comparing your performance to that.
Well, we do. You have to be compared to something.
Right.
That's the report card, but we're not going to set up the portfolio looking to see what's in the Russell. I guess the top 10 holdings in the Russell, we own none of them. I mean, Evan reminded me that our active share, which is the amount that's not in the benchmark, is 95%, which is said to be very, very high. So over time, if you have good absolute returns, the relative returns take care of themselves.
And let's talk about what you're looking for, what you mean by absolute returns.
Absolute return is if we're up 10% and the market is up 11%, we're not going to be apologizing for trailing a market by 1%. If we're down 5% and the market's down 10%, we're not going to be happy, even though it's quote unquote good relative numbers, because you've lost principal. Over time, we want to try to put up very strong absolute return, just to give the investor a good return. I've always said, from when we started it, we manage money for a hypothetical woman that lives in Iowa, a 75-year-old woman, never heard of the Dow Jones average, never heard of the Russell, maybe heard of the S&P. All she wants to do is get a good return on her account. She doesn't want to be told, you had a good year, you lost less than the quote-unquote market. She just wants to have a good return that she could use. And people, I don't mind if people take some of the money out that they've made over the years. They should be able to use and enjoy some of the proceeds.
So 1983, how did this happen? Because you were an analyst.
I guess it was May of 1983. A very good friend of mine, Elliot Fried, who was the research director at Shearson, met him in 1976. He was a great friend. He's a Wall Street legend. Called me in May of 1983 that Shearson would be launching the Shearson Aggressive Growth Fund. Would I be interested in managing it with him? And I've always wanted to manage money, and it was the easiest phone call I ever had.
I'm just thinking of, when I look at the profile of the fund, we talked about the fact that it is a very low turnover. But the other thing that is really unusual about the fund is that it's so concentrated. I mean, you've got, half of the fund is in the top 10 holdings, 35% is in the top 5. A third of the fund is in healthcare right now, 20% is in technology. Why are you running such a highly concentrated portfolio?
When a lot of those companies started out in the portfolio, they were very, very small. They were micro-cap names. IDEC Pharmaceuticals in 1991 was a micro-cap name.
And it's now Biogen
now it's
IDEC.
Biogen
and
IDEC.
It's now, 11% of your portfolio? So tell us the story of, and this is kind of the story of how you invest as well,
okay,
of how it happened that it's now 11% of the fund.
I think it's emblematic of how we look at companies.
Right.
The CEO of IDEC had come out of Genentech. Genentech was our first stock that we ever bought, October 24th of 1983.
Genentech, right.
So I saw Bill Rastetter was over at IDEC Pharmaceuticals. We looked at it. We liked the product that they were involved in. It turned out that the initial product of theirs failed. They then teamed up with Genentech to design clinical trials on Rituxan, as it turned out, which is a blockbuster drug. We bought the bulk of our stock in 1995 because it had the characteristics of what we liked. They were serving an unmet medical need. It can really make a difference in people. The company can serve a very large market, a top-tier management team, backed by a very, very strong partnership in Genentech. And in retrospect, we got awfully lucky because they executed, merged with Biogen then in the early 2000s, and it's been a very, very fortunate stock. But again, it has the characteristics, not just in healthcare, but be it an oil company like Anadarko or a cable company like Comcast.
Right, again, these are your top 5 holdings.
It throws off a lot of free cash flow. I don't understand why any investor would make an investment if he didn't think over time the company would not generate cash, because that's what you're left with. At the end of the day, you want companies to generate cash, and the biotech companies had that ability. Not early on, when they were consumers of capital, but over time, they've been enormous generators of cash.
So, but what I don't get, Richie, is that you've held these stocks, as you said, some of them since the 1980s, some since the 1990s, but you've ridden these stocks up and down. So what happens when you're in the midst of like a financial crisis or the crash of '87, and you're holding these companies, and I know you've gotten, I'm sure, flack from your investors and saying, what are you doing, Freeman? The stock's down, X%. What do you do in a situation like that?
I heard it very often from my wife in 2008, in fact. If you look at the market over time, you understand the market's going to fluctuate. I mean, Joe Granville always said, stocks are like people, they have to breathe. And as long as you have a sine curve in an upward direction, that should be the goal. But there are going to be periods of time where you're going to be hit with unexpected negative news. Call it headline risk. We owned a company, Chiron, a biotech company, which single-handedly, in retrospect, caused the flu vaccine shortage about 7 years ago. A plant that manufactured the vaccine for them was contaminated in London, had to pull the supply, shut down essentially cut off a lot of the flu vaccine in the US. The stock plummeted. A lot of investors worried. We looked at what the company was worth, Xing out the flu business, and we thought that the valuation was incredibly compelling and added to it Luckily, then Novartis came along and acquired them a couple of years later. Biogen Idec, which we mentioned, is another company. It's been through headline risk. They had a drug which they voluntarily pulled off the market 6 years ago because it had some side effects. It was then put back on the market. The stock had fallen to a level which we think removed any value for that drug, and the company has gone on to make all-time highs. Anadarko Petroleum, another headline risk company, they had a 25% investment in the Macondo well, which they were right. There was a lot of oil in that well, except it was flowing into the ocean as opposed to into the pipes.
Right.
The stock fell precipitously. We took a look at what we thought the valuation of Anadarko would be under a worst-case scenario, and we thought that the valuation was more than being discounted by the stock price coming down. So we held on to Anadarko, and it's come back and made all-time highs.
So let me ask you about that, because when you're talking about headline risk, you're sounding like a value investor to me, like a deep value investor. So when you have headline risk and the stock goes down, what's your strategy?
Well, the one thing a growth investor hates is when his stock becomes a deep value stock.
Exactly.
Right. But you have to look at it after the news is out. You have to take a look and reevaluate it. What is it worth today with all the information that's out there? Wall Street is very emotional. Wall Street tends to over-discount events and tries to when things are going good, they'll always overshoot, and vice versa on the downside. So we try to become unemotional in a very emotional business, and we try to make a best judgment where this company is going to be 2 to 3 years out.
According to Morningstar, your risk profile is high on the fund. The fund captured 109% of the Russell Growth Index in the upside, but in the last decade. But it also suffered 112% of declines. So is volatility? That's just the name of the game with a growth fund. Is that? How do you explain that?
Volatility is just a byproduct. It's nothing that we're going to control. All we care about at the end of the day are the companies, and if we're able to put up strong numbers, we've been very, very fortunate. We try to buy great companies. Great companies over time will become great stocks. A lot of people buy great stocks thinking that they're great companies, and it doesn't work that way. I mean, great example is Facebook. We thought that eventually this could be a great company. We thought it was a great company when they came public.
So let me stop you there. So tell me about why you decided to buy Facebook.
Okay.
And you bought it at the IPO, is that right?
We bought probably 100,000 shares at the IPO of at 38.
The initial public offering, right?
Yep. We thought that had over 1 billion users. We thought it was a sticky product. We didn't think it was a fad. We thought it was a powerful trend. You contrast that with MySpace from a number of years ago. We liked the management team. The CFO of the company has been in our office when he was with Genentech. He was the CFO of Genentech. And the IPO, in retrospect, was an enormously successful IPO. When people hear that, they say, how are you saying that? The stock price declined. Well, it was very successful for the company, not so much for the people that bought it at 38, and unfortunately, many of them sold it lower.
No, including you, who bought it.
Yeah, that's right.
At the initial public offering price.
Guilty as charged.
Right.
But for us, that was a small position. And we have a number of positions, maybe 20 positions, that are going to be very small, relatively small in the portfolio. We'll call it the bullpen, where by putting it in the portfolio, we will watch them much more closely. Either we can sell it if we don't like what's developing, or we can build it into a bigger position if the price is right and if we see certain things happening. The lockup ended. Many of the insiders were selling it. Evan and I,
didn't that distress you at all? I mean, isn't that a sign that you should be getting out too if they're bailing out?
We actually welcomed it in that sense.
Really?
Because our work told us that they weren't losing any share.
Right.
We thought there was a chance that Wall Street was looking at this company incorrectly. To us, target advertising is an explosive area, and it wasn't being looked at correctly. We bought probably 2.5 million more shares. Our cost basis is about 24. So in retrospect, it's been a lucky holding, because we never thought it would rally back as fast as it did. But that's an example of headline risk.
Right.
And headlines are good for selling newspapers, not for making money in the stock market.
So in the bullpen, which I love that concept. I mean, how many stocks do you have in the bullpen that you have small positions in, and you're
small position defined as probably 40 basis points, 50 basis points. We have a dozen or so, but they're small. We usually don't talk about them.
You mean this is half a percentage of the portfolio?
Well, now Facebook is probably a little under 2%,
right.
But it was very small when we first
right.
when we first bought it, because we weren't going to bet the ranch at that price.
So in the bullpen, I mean, are there any stocks that are relatively new holdings that you think that with confidence that if things go the way you think they're going to go, that they'll be in the portfolio in 10 years or in 20 years?
We hope so.
Right.
I mean, we don't know. We don't
right.
know how things are going to be developing, but if we see the things If we feel more comfortable and it's not being reflected in the stock price, we'll add to them. That's what we did with Genzyme, which we first bought back in 1989. I remember doing it with Amgen also in the 1980s. They started out as small positions, but certain things developed. The stock prices didn't skyrocket before we added to them, and we got lucky.
Right. Biotech, big holdings of yours. I mean, United Healthcare is a big holding. So explain the United Healthcare story. I guess it's what, number two? Your second largest holding, 8% of the portfolio?
Yeah, bought UNH in 1991. It was a premier health company. We also owned U.S. Healthcare at the time. We bought United Healthcare and U.S. Healthcare. U.S. Healthcare was acquired by Aetna. United Healthcare grew dramatically through acquisition. It has all the characteristics of a company that we look for. Great management, large addressable market. They throw off an enormous amount of cash, and they're shareholder friendly. They return cash to us as dividends. I mean, dividends never counted for anything in this fund. The yield was always NM, non-meaningful.
Right.
UNH now pays almost an S&P kind of dividend. It's been raised significantly. And they've been buying back billions of dollars worth of stock, and the earnings per share have grown nicely.
So again, this is a growth fund, and you own a United Healthcare. So at what point does that fit your growth profile?
To me, a growth stock's a stock that goes up. Period. That's what that's the goal.
Okay.
People always, they try to make the distinction, as you said, between growth and value.
Right.
A growth stock is one that we think could advance in price. And people always try to pigeonhole us saying, what criteria do you use, that it has to sell at under 20 times earnings, more than 30 times earnings. We like to buy them if they're selling it. Ideally, if you can buy a company at less than its growth rate, that's throwing off so much cash that they can buy back stock, pay you a dividend, invest in other companies and grow that way. Those are, that's the triple play, that's the home run.
So when do you sell a stock? Do you sell stocks?
Well, we have a turnover, so 8%
I know you
is
did
there.
8% a year, right?
We have a lot of involuntary turnovers when you have takeovers, and you
Right.
mentioned the biotech area. We've had many of those companies have been part of our turnover over the years. Genentech was acquired, Chiron, Genzyme, ImClone was acquired, Millennium Pharmaceuticals. We had GenProbe that had been acquired. Genentech itself, as I said, was acquired by Roche.
And of course, those are all positives because when a company is acquired, they're usually acquired at a premium.
And those are always surprises.
Right.
I'm always the most surprised guy when that happens. And also, when names get to be too large a portion of the portfolio, we will trim them down.
So I'm just looking at, so Biogen IDEC at 11% is not too big.
It's been trimmed.
It has.
We have sold over the years, quite a bit of that stock because it's up dramatically to try to keep it at the roughly the 10% area. We had taken some off the table in Anadarko Petroleum. Genentech, years ago, we sold a lot when it was over that 10% level. UNH as well was over 10%. We trimmed it down. And there are other instances where we'll sell a stock if we think the risk reward is poor. We had Oracle. We bought Oracle and Lotus the same day in 1991. Lotus was acquired by IBM in mid-1990s. Oracle we started selling in 1998 and sold the rest of it in 1999. Based on just purely on valuation. Mm-hmm. That one just felt that if they would ever miss earnings, so we had no reason to believe that they would, if they would ever miss earnings by a couple of pennies, the stock, based on its valuation, would suffer dramatically. So I remember after selling Oracle, the stock probably doubled in the next year before going down 80% after that and the dot-com breakdown of 2000, 2001.
Biggest investment mistake you've made in the portfolio?
There's only a half
or
hour,
in life?
This is only a half-hour show, isn't it?
But is there one big mistake that you made that you really learned a lesson?
In the year 2000, we were up, I think the fund was up a little over 19%. But we were up
9 or
19%.
Right.
At one time, I think we were up over 30% that year and gave back some. Even though it looks greedy, you were up a lot in a down year for the market. It still to this day bothers me that I didn't take more off the table.
You've been through booms and busts, you've been through the '87 crash, you've been through the Great Recession, the financial crisis, whatever. So what's changed in how you invest? Has anything changed? I mean, how have you adapted to these various?
I think the biggest difference is when you speak to companies, they're not as helpful as they were back before the advent of full disclosure. So you just have to find other ways, to invest. I mean, you can't call up the IR person and expect to find out what the orders are every month because that's not legal. So obviously it's not done now. You didn't have computers back then where everybody had access to the internet. If you wanted to do research on a company, you had to call up the company to get the annual report sent to you. Now you can just go to your computer, get all the information. Companies, when they put out events, will put out a conference call so everybody at the same time has access at the exact same moment.
Right. So the competitive advantage that one used to have if you had big holdings or whatever is gone.
But we still find ways to do okay.
Right.
Because at the end of the day, it comes down to how do you value companies, period. And that hasn't changed. And I think one of the negatives that's happened now versus years ago, I think the public almost feels that they're compelled from watching a lot of shows, and not this one, and that's why I like this one. They almost compel the public to make trades. What are you doing today? How are you trading the market over the next couple of weeks? How are you going to react to the budget deficit? To me, that's not the way to make money for the long term. You try to identify great companies, you monitor them closely, you increase your positions if the market accommodates you, gives you some weakness, you cut back into extreme strength, and don't be scared out of positions by a lot of macro events.
So, during the financial crisis itself, which, was kind of a near-death experience for many portfolio managers, and certainly, you suffered as well, is there anything that you're doing differently as a result of what happened in the financial crisis?
I would say no.
No.
And the only way you can really tell, you ask a manager, did he change his portfolio? Did he change what he did after the crisis? And he'll say no. But then you ask for his turnover. And if his turnover changed appreciably, then you know he really did make some changes. Our turnover didn't change afterwards. So some of the stocks that clearly hurt us on the way down have been some of the biggest beneficiaries in the portfolio. Seagate got down to 2 3/4, as did Liberty Media back then. Liberty Media went from 18 to 2 3/4, the John Malone company. And we got lots of questions from clients. I mean, how do you justify charging us a fee when you have Liberty Media go from 18 to 2 3/4? We held on to it. Liberty Media now is 145, not including the distribution of Starz Entertainment that they gave us for another $27. I mean, that's an extreme example, but if we would have become more conservative afterwards, as a lot of people did, we wouldn't have had the benefit of the recovery.
One investment for a long-term diversified portfolio, we always ask our guests this at the end of every Wealth Track. So what would you have us do, or what would you have us own, Rich?
Hall of Fame golfer Lee Trevino tells a story which I think is applicable to this show. He said, the most nerve-wracking thing is when you have a $10 putt with just $5 in your pocket. In other words, you better be perfect. When people run up a lot of debt, they have big mortgages, a lot of credit cards, that's okay as long as a lot of money is coming in, there are no financial problems, but what happens if something changes? So I've always told people, debt is the dirtiest word in the financial business, dirtiest 4-letter word. A lot of people don't agree with me, but I will always say, even for younger people, if they're able to, pay down your mortgage if you're getting money in, pay down your credit cards. Try to remain as low debt as you possibly can, because I think you can make better judgments if things do get rocky. So I feel very strongly about that.
Relate that to your investment management approach.
If you look at the holdings in the portfolio, you look at the balance sheets, you have companies like Forest Labs with $12 a share in cash, no debt. You have Biogen Idec that was able to make a $3 billion acquisition for cash this year because they're throwing off billions of dollars of cash with no debt. Anadarko doubled the dividend. They generate positive free cash flow. Comcast was able to buy the NBC Universal venture because they're throwing off so many billions of dollars of cash flow. To me, cash is the most important thing. It's what every investor should be striving for. Why do you want to own companies that are debt-ridden, that are consistently worried about rolling over debt? You want to try to control your destiny. Now, there are going to be events like 2008 that will pressure a lot of companies. And if that's the case, you want to have companies that, as best as they can control their destiny. They don't want to be beholden to the person that they're rolling over money from. So that's how I feel.
Great point. Rich Freeman, such a treat to have you on Wealth Track at the 30th anniversary of the ClearBridge Aggressive Growth Fund. We really appreciate it.
Love your show, Consuelo.
Thank you, Rich.
Great.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is don't get hung up on investment labels. As we just heard from Richie Freeman, the aggressive growth label in his fund, given 30 years ago at its launch, is a misnomer and does not describe the nature of his fund, which seeks stocks that offer the best absolute returns over time. And unlike many other so-called growth funds, Freeman's portfolio has an extremely low turnover, not a characteristic of a typical aggressive growth portfolio. So your best bet is to know a fund's investment objectives and approach, and if it has successfully achieved them over time. I hope you can join us next week. Gluskin Sheff's influential economist and strategist David Rosenberg is reversing his 20-year deflation call. He says we are entering a new era. He'll tell us why and what it means for investors. Until then, please visit our website to see past Wealth Track episodes. Additional interviews with our guests and valuable research from our sources are available on Wealth Track Extra. And feel free to connect with us on Facebook and Twitter. In the meantime, have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Rosalind P. Walter.